Hi, welcome to Business Time. I am Melisha. Remember to subscribe, like, and share. Today, we'll be looking at the double entry system. Now, double entry is a system where each transaction is entered twice, once on the debit side and once on the credit side. So remember, every credit entry has a corresponding debit entry. Now, let's look at some rules for entry of transactions in the double entry system. For assets, whenever there is an increase in assets, assets are to be debited. Whenever there is a decrease in assets, assets are to be credited. For expenses, whenever there is an increase in expenses, they are to be debited. Whenever there's a decrease in expenses, you must make sure to credit. And if you realize it's the same principle for assets and expenses, increase in assets and expenses, those are debited. Decrease in assets and expenses, those are credited. Now, for liability, income or revenue, and capital, whenever there's an increase in those, you credit them. Whenever there's a decrease in those, you debit them. So, an increase in liability, you credit. A decrease in liability, you debit. An increase in income, you credit. A decrease in income or revenue, you debit. An increase in capital, you credit. A decrease in capital, you debit. Now, it's important that you remember these rules because these are the rules that you're going to rely on to enter the transactions correctly in the double entry system. Now, the T account is an informal way that is used to visually represent when transactions are being recorded using the double entry system. So you will hear me say T accounts. Let's draw the T account. And a little later on, you'll get to see exactly what this T account looks like. It is important to take note that when a transaction is going to be recorded, it must have the name of the account, the date, that is when the transaction took place, the details, that is the name of the account where the corresponding debit or credit entry will be found, and the amount, which shows monetary amount of the transactions. Those are the common ones. For more detailed recording of transactions, you will have what is called a folio, right? So this shows the initial of the ledger where the account is, such as the purchases ledger, and you'd put PL in the folio section. But those that I'm going to show you, they will just have the name of the account, the date, details, and the amount. All right, so we start as simple as possible and make sure that you get it. It is also very important to remember the different types of assets and liabilities to be able to do the double entry properly. So remember, several types of assets are things like motor vehicles, premises, inventory, accounts receivable, cash, bank, machinery, and building. And you would have learned that when you were doing the balance sheet. Okay, now different types of liabilities are like accounts payable, loan from a bank or loan from others. For example, you may see in a question, loan from D. Jones. There are some specific things that you need to be aware of. For example, double entry system for assets and inventory. Now, various accounts need to be open to keep track of movement of inventory. So, for example, you will need to record to have a purchases account. Now, this is used when goods are bought, right? So, in this case, you will always debit purchases account when a purchase is made, right? So you will always debit the purchase account and you credit the other account. So whenever you see a transaction where it says the business bought goods, it's important that you remember you write a purchases account for that and not a goods account. For whenever the business sells goods, the account that you will write up for that is a sales account, right? And remember, when the business sells goods, you always credit the sales account and then you debit the corresponding account in that transaction. So you always credit the sales account whenever the business makes a sale, and you always debit the purchases account whenever the business purchases goods. Now, there is also something that will happen from time to time, and you have to have a special account for this. So when goods are returned to the business by the customers, you open what is called a returns inwards account. There can be various reasons why your customers will return goods to you or to the business. It could be that the goods were of the wrong type or the goods were damaged. Whatever the reason, you must open a returns inwards account. And guess what? You always debit the returns inwards accounts whenever goods are returned to the business. And of course, you credit the corresponding account. Now, also, the business for some reason as well may have to return goods to their supplier for different reasons. The goods may have been the wrong type, damaged, etc. What this simply means, a returns outwards account must be created. Guess what you do? You always debit the returns outwards account whenever the business returns goods to its supplier. And of course, you will debit the other corresponding account. So remember, you always credit the returns outwards account whenever the business returns goods to its supplier. Good? So key thing to remember, purchases account is to be debited whenever the business buys goods. The sales account is to be credited whenever the business sells goods. The returns inwards account is to be debited whenever goods are returned to the business by customers. You always credit the returns outwards account whenever the business returns goods to its suppliers. So these are things that you have to try to remember. Okay? Something to note. Take note that different types of expense accounts will need to be written up, such as rent account, telephone or internet account, stationery account, salaries or wages account, advertising account, motor expense account, insurance account, postage account, just about any expense that the business may have to deal with. For revenue now, there are different types of revenue account that you may have to create, such as rent receivable, commission receivable, bank interest receivable. So take note that these expenses need to be identified, need to be specified, so that the business can easily know which expense or which revenue an account is. Okay? So we are now going to practice how the double entry system is recorded. A great tip to do the double entry properly is to at least know how one of the accounts is to be written up. So if you can figure out which account will be debited or credited, naturally the other account in a transaction will be on the other side. All right, so we're going to try and get this done in Excel, and we'll see if we can, this is the best possible way I think I could get it done for you to have an idea. So you remember before I mentioned that we'll use a T account. Now look at this. So you see it shaped like a T? So I guess you can figure out why it's referred to as a T account. Now, on the left hand side, always remember that that's the debit side. And on the right hand side, always remember that that's the credit side. And remember, I said to you, when you're doing your account, in the double entry using the T account, now you're going to need to write the name of the account, which I'm going to show you up top. You must have the date, that is when the transaction took place, the detail, you know, which will be the corresponding account that we can find the same information in, and also the amount. All right, so let's look at this question. So let's move over to the right here. It says, write up the following transactions in the books of J. Blake for March 2017. Good. So now, the first question, March 1, started in business with $15,000 capital in cash. Now, what two accounts can we get from this? We see capital and we see cash. Now, let's write this first account, and we're going to put it here, and it's capital. So let's put that in capital account. Now, remember we said that whenever there's an increase in capital, you credit. So we're going to put it on the credit side. So we're putting the date. We have the year already. So we're going to put in the date March 1. Good. So in the details column, we're going to put cash, because when we go to the cash account, we'll also see this information. All right. And what is the amount? The amount is $15,000. Good. All right. So remember the rules of double entry. Once there is a credit entry, then the next one will be a debit entry. So of course, the next account that we will need to look at is cash, because $15,000 was put in cash. So we're going to write up this as a cash account. Cash account. Now remember, there's an increase in cash, and when you increase in an asset, remember cash is an asset. When you increase in an asset, you debit, right? And you still have to remember always to put the year. Okay. Let me see if I can get this to let me see, March 1. Don't want it to change. All right, good. March 1. Will it change? Text March 1. All right, good. So if the date changes, you know, but at least you have an idea that this is how you put the date. Okay. And in the detail here, so remember, you will need to put the account, the corresponding account for this transaction, which was capital, right? So you put capital in here, and then you put the amount, which is $15,000. Great. So remember, in the double entry system, for a transaction, when one account is credited, the other must be debited. So if I look at the cash account alone, I can pick up that, okay, the other corresponding account for this transaction is in the capital account, and I can go over to the capital account and I can see that. Good. So let's move on to March 2. So let's look at the question over here. March 2, paid for $14,000 of the cash into a bank account for the business. Paid $14,000 of the cash into a bank account. So where is the cash going into? Into the bank account. So now the two accounts that we will have are the cash account and the bank account. Now, the fact is that we are decreasing in asset as it relates to the cash. When you are decreasing in asset, you need to credit. Good. So we're going to credit the cash account. And remember, the date is very important. Good. So March 2. And what's the corresponding account for this transaction? It will be the bank, because money was taken out of the cash account to put into the bank account. Good. And what was the amount? $14,000. Good. So now we don't have a bank account here, and so we're going to have to open a bank account. So we go down here. Here is our bank account. Remember, we're getting money into the bank account, which means that, hey, there's an increase in asset, and so it has to be debited. So our bank account, March 2, in the detail, what's the corresponding account? It's the cash account. Good. So I put the cash account there. And how much was it? $14,000. All right. Great. Hope that you're getting it so far. Let me just put that there. All right. So let's move down to another date. Well, same date, another transaction took place on this date. March 2 again. Bought goods on credit from J. Paul for $592. No. Bought goods. When you buy goods, what did I say? What type of account you're supposed to open? A purchases account. So let's write up our purchases account. So remember, purchases account is for whenever goods are bought. So this was March 2. So we put in March 2. In the detail, what's the other account? Bought goods on credit from J. Paul. And so J. Paul right there is our creditor. And that's accounts payable, because we're going to need to pay J. Paul. But once the name is there, we put in the name J. Paul. That's who the business is owing. Right? So bought goods on credit from J. Paul. And we're putting the amount that's owed, $592. So we did not have a J. Paul account before, and so we need a J. Paul account. So let's go down and do a J. Paul account. Oh, one of the things I need to remind you of is try to have the account names in the center. Put the names in the center, okay? So this one is J. Paul. So of course, purchases was even without trying to remember, accounts, when you increase in liability, you credit. But remember, I said to you, once you can figure out what is to happen with one account in a transaction, once you debited purchases, naturally you're going to need to credit J. Paul's account, right? So you put back the date, March 2, and you put purchases, and you put the amount, which is $592. All right. So now we're finished with March 2. All right. So we have entered information in both accounts. So let's go to March 4. Paid for rent of premises by cash, $250. And bought a motor van for $3,000, paying by check. No. Here is an expense, paid for rent. And remember, when you increase in an expense, you debit, and you're reducing in cash because you're using the cash to pay for the rent, then you're going to decrease in it. And so it's an asset. So you're going to credit the cash account. All right, so we had a cash account before. Good. So, and remember which side we're putting it on? We're putting it on the credit side. Good. So we put in the date, March 4. What's the corresponding account? Rent. And how much is the amount? $250. And we have to create the rent account right away before we forget, right? There was no rent account before, so we have to do one. Rent account, so remember the rent goes on the debit side, which is March 4. It was cash we used to pay for the rent, and the amount was $250. All right. So the next part of the transaction was bought a motor van for $3,000, paying by check. Bought a motor van for three. So remember now the rules again. When you increase in an asset, which is a motor van, you debit. The bank, you're decreasing in an asset because you're using what is in your bank account to pay for this motor van. So you're going to credit it. Good. We had a bank account. Yes. So we can go ahead and put in this information. So it is March 4. Put in March 4. In the detail column, it's a motor van that the business bought. Motor van. And what was the amount for the motor van? $3,000. Good. We did not have a motor van account, and so we are going to have to create one. So let's go down. Motor van. So it's, remember, it's to be on the debit side. So it was March 4. Use the money in the bank to pay for it, and it was $3,000. All right, good. So let's look at the next transaction. March 5, bought goods, paying by check, $2,100. Now, remember, whenever you see goods and when you bought goods, what is that called? Purchases, right? And of course, when you buy goods, remember, you always debit the purchases account and check. You're reducing, you're spending money here, and so you credit to your bank account. So remember, whenever you see the words check, it's bank. You get that? So here is our purchases account. We had a purchases account already, and so we're gonna put March 5. We're using money from the bank, put in bank account. We're using a check, and the amount is $2,100. All right, good. So we need now, so we debited the purchases account, so the bank account will have to be credited. So that's March 5, and what we put here in the detail is purchases. And how much is the amount? $2,100. Are we good? All right. So the next transaction, March 9, sold goods to E. Ford for $323 and received a check. So remember, when you sell goods, when the business sells goods, what is that? What type of account is that? I'm also giving you an opportunity to try and get the answer as well. Okay? So it's a sales account. Whenever you see goods, all right, it's sales, right? So sold goods, it's sold to E. Ford. However, E. Ford paid by check. And so E. Ford is not owing the business anything. So the two accounts here would be sales and bank. We have our bank account for sure, and so we're receiving money, and so we will debit the bank account, and so that's March 9. And what's the corresponding account? Sales. What's the amount? $323. Good. Now, did we have a sales account? No, we didn't, and so we have to write up a sales account. Sales. Good. So remember, sales, once you sell goods, the sales account is always credited. Okay, so we put in the date, March 9. In the detail, we put bank and the amount 323. All right, so let's look at the next transaction. That's March 9. March 11, paid for printing of stationery, $45 by cash. So here we have another expense, right? And so you're going to always remember, you always debit your expense, right? And you paid by cash, debit your expense here because it's something that the business will have to deal with, right? And you used cash to pay for it, and so you're decreasing in cash, so naturally you're going to credit your cash account. All right, so we have the cash account up here, so we are going to credit the cash account, and that was March 11. Yes, March 11. In the detail, the expense is stationery. Stationery, and the amount is $45. Yes. All right. Can expand that a little bit. All right. We did not have a stationery account before. No, we didn't. So we have to create a stationery account. That's an expense. And so we are going to debit it. All right, so it was March 11. In the detail, it was, what was the corresponding account? Cash. We paid by cash, and the amount is $45. We're correct, right? Yes, paid by cash, $45. All right, so let's look at March 14. March 14 says cash sales, $490. So of course, the business made some sales, right? And the business received cash for the sales. So what are the two accounts? The cash account and the sales account. So in this case, we're increasing in cash, and so that's an asset, and so we debit it. So let's go to the cash account. Where is the cash account? Right here. So March 14, and it was sales. How much was the amount? $490. Good. So let's go to the sales account that we need to credit. Where is the sales account? So that's March 14. Always in the detail. Was cash. March 14, yes, cash sales. So it was the cash account we had written it up in of $490. All right. So let's look at the next transaction. March 18, goods returned by us to J. Paul, $67. So remember now, goods returned by us. Who is the us? It's the business. So when goods are returned by the business to its supplier, who in this case is J. Paul, that is returns outwards. Remember that now? Returns outwards. So the two accounts here will be returns outwards account and J. Paul account. And of course, remember, you always credit returns outwards accounts, right? Whenever goods are returned. We have a J. Paul account here, so we're going to be debiting the J. Paul account. And what was the date? March 18. And in the detail here, returns outwards. Let's see if I can whoops, wrong line. I can expand this a little bit more without getting into trouble. Let's see if I can minimize this one. Minimize it a little bit more. All right. So returns outwards. So March 18, JPaul account returns outwards. March 18 goes returned by us to JPaul, $67. Good. So we now need to create a returns outwards account. Returns outwards. Did I spell that correct? Okay, good. March 18, JPaul, that's who we returned the goods to. And the amount, $67. All right, good. All right. All right, so we're at March 19. Bought goods from JPaul on credit. When you buy goods, what is it called again? Purchases, right? You buy it on credit from JPaul. That means we have created accounts payable. And so we will have to credit JPaul. So purchases, so we debit purchases and we credit JPaul. So this is March 19. So let's look for purchases. So of course we're going to debit purchases. And that's March 19. And in the detail, we put JPaul. And the amount is $720. All right, so let's look for JPaul account. It's right here. So we're going to credit JPaul account. So put in the date, March 19, and we put purchases. And the amount is $720. Good. All right. So March 21, paid for advertising, $60 by check. Now this is an expense, and remember we always debit our expenses when we have them to pay for. And of course the bank, your check, you are spending money, right? So you're decreasing in asset right here, and so you credit it. All right, so we are going to debit advertising and credit bank. So let's look for the bank account. Where's the bank account? Here. So remember, we're crediting the bank account. So it's March, what was it? March 21. In the details, advertising. How much is the amount? $60. So we're going to open an advertising account that we're going to debit. We did not have any previous advertising account, so we're going to have to create one. Advertising. Remember, we debit. So that's March 21. And bank, we paid for it with the check. And the amount was $60. Good. All right. Now, March 24, sold goods for cash, $500. What are the two accounts here? Can you pick that up? Yes, sales and cash, if you got that correct. Very good. Now, what do you do with the sales account again? You credit. And what are we going to do with the cash account? Debit. Excellent. All right, so let's go to the sales account. All right, we're here. Where is the cash account? The cash account is right here. So we can just go ahead and do the cash account. Yes, March 24. So it goes for cash. Okay. Cash. So we're getting cash. So March 24. Sales in the detail. How much was it again? $500? Yes. So we need to go to the sales account now, credit. So we put the date, March 24, and cash, 500. All right. Alrighty, so let's look at this one. March 25. Paid the following expenses by check. So right away we know all these expenses are to be debited and the bank will be credited. All right, so let's go. So we can put these in the bank account. So we know that we have to credit the bank account right away. So we put a date, March 25. What is it that we need to credit? Wages of 540. What was the next one we need to? March 25 again. What's the next expense? Motor expense. Let's type that in. Not motor van, motor expense. How much is that? 110. What's the next expense? Stationery. March 25. Stationery. That's 82. Whoopsie. Whoops. Let's do that again. Stationery is to be written up here. $82. All right, so we now need to write these in their different accounts: the wages account, motor expense account, and the stationery account. So let's go for wages. I remember these are to be debited. Did we have a wages account before? No. All right, wages debited, March 25. Bank, and it was for wages, it was 540. What was the next account? Motor expenses. I don't believe we had that expense before. Whoops. Motor expenses. All right, let's put in the date, March 25. What's in the detail? Bank, and motor expenses was how much? $110. And the next expense was stationery, $82. We have a stationery account. March 25, bank, stationery was $82. $82. Good. All right, so we'll put in all the expenses in their different accounts. All right, March 28, paid J. Paul $1,245 by check. What are the two accounts here? J. Paul and bank. What are you going to do with the bank account? Going to debit it or credit it? Which one? You are going to credit it because you're spending money, right? So you're decreasing in asset. So March 28 for the bank account, credit it. March 28, J. Paul how much? 1,245. All right, so we need now to go to J. Paul's account and debit it. So here is J. Paul's account. So March 28th, bank, and it's 1,245. Good. So we're on to the final one. Yay! All right, March 31, sold goods for cash, $526. So what are the two accounts here? Sales and cash. If you got that correct, great job. So what do you always do with the sales account when you sell goods? You credit it. Excellent. You paid for the you received cash from the sale of the goods. So what do you do with cash? Excellent. You debit it. All right. So let's look at the cash account. We have it somewhere up here. So we're going to debit. How much was the amount? So we're good for cash, 526. All right. So cash was March 31. All right. March 31. Sales 526. So we go to the sales account and credit it. March 31. Cash. And how much was it again? 526. 526. All right. So that is how you do the double entry system, right? So remember that for every debit entry, there is to be a credit entry. For every credit entry, there's to be a debit entry. And one of the things that you want to do is to line up your work properly. Again, too, you don't always have to write up debit and credit here. And in some cases, you may just see DR. Some cases, you may see CR. Same thing, debit or credit. All right. Yeah, that's about it for now. So one of the things for you to do well in accounts, you have to practice. You have to try to remember the rules. And the only way to remember the rules is to practice the questions. So for every question that you have ever gotten, right, to do, what you're going to do is try to do them on your own without even looking at the answers. And then you check, the answer to see how well you have remembered them. All right. Hope you learned something. See you next time.